Welcome, everybody, to CRE Fast 5 Secret Sauce, the show where we hear real-time insights from commercial real estate industry leaders. I'm Karly Iacono. Today, I am so pleased to be joined by Jason Bogart, principal of Accordia Realty Ventures. Jason, welcome to the show. How are you today?
Doing great, Karly. Thanks for having me. Really appreciate it.
My pleasure. We're going to have a lot of fun today, a lot of good information. And I have to tell you, one of my favorite things is sitting down with owners who not only are bullish on retail, but also have had success across other property types.
Sure.
Because I think you have a really diverse and interesting perspective. People hear me talk about retail every day, all day long. So hearing it from someone who has experience in other asset classes, I think will be especially interesting to our listeners.
Great.
So before we jump into all of today's fantastic content, why don't you take a minute and just tell us about yourself and Accordia?
Sure. Jason Bogart from Accordia. Accordia is now, will be entering our 20th year in business. My partner, Joe Romano, and I founded the company in 2005. Joe recently retired and kind of left the reins to me to handle the next generation. So we're gearing up for a new platform and kind of rebranding ourselves. And we are privately owned, and we've done real estate from Long Island to Delaware as far as our history goes, and looking to expand and get into some new markets and some new asset classes.
Exciting. So you're taking the previous success, building on it, pivoting, and coming over to the dark side of retail more and more.
Correct.
I love it. I love it. So tell me kind of how your vision for the company differs from your partner that just retired, or what are you hoping to add to it?
I think a lot of our core values have stayed the same. So we have kind of what I would call two different divisions of the company. And one is, we buy stuff for our own account, stuff that's more stabilized. I wouldn't say core, but core plus assets that we hold, and they're kind of generational legacy assets that stabilize the company for us. They create cash flow and fees and keep our lights on and our overhead. And then the second part of our company is where we're very institutionally oriented. In other words, we end up being a local partner in a joint venture with large institution, pension fund advisors, money managers, family offices, and the like. And that is two separate business plans because the joint ventures are normally value add, where there's some level of a component where you're creating some value, you're taking a little bit more risk than our core assets. And that's kind of where retail fits in for us a little bit into this new business plan.
Interesting. And was this a directive of those investors that you mentioned, just seeing additional opportunity, or are you bringing it to them saying, we think there might be additional yield or upside that we can't find in other asset classes? Kind of what was driving that shift?
It's really an internal motivation. It's something that as we grow, we do take a lot of risk in our deals, and retail for us is a way to, on some level, flatten that risk profile. In other words, we can buy assets that are grocery anchored or have some kind of inline service that really are more stable than some of the other asset classes where we're developing ground up or we're taking an asset that has some real problems to it. And so retail gives us a little bit more stability. But within that sector, there's also a lot of risk profiles as well.
Huge diversity of risk profiles in retail, but I love that you said you were moving to retail for stability. I think a lot of people look at it the other way and say, we could add this retail piece on, but it's going to be higher risk. And I love that you're looking at it the other way. So in terms of diversification, before we move on, are you thinking of this as asset type diversification only? Or are you looking at it as a way to get into new markets that maybe you can't access with your ground up development?
It's a little bit of both. Excuse me. So in the Northeast, we're based in Fairfield. So, we can normally handle anything within a 3 to 4 hour drive as far as risk profiles. And that includes ground up development, redevelopment, skinning buildings. So we can go through various, really heavy value add and opportunistic deals when we're close to home. We are expanding our region and our geography to try to get into the Southeast. We have a new head of acquisitions coming on board, and it's his job to get us into those markets. When we're a little further from home, it's harder to just start out with heavy development and redevelopment. So we really want to establish a beachhead, kind of get us a portfolio going, get a new office set up, and then we can dive back into some really heavy value add type stuff. So that's the goal, is try to get us out of the Northeast. Not completely. We want to stay here. This is our home base. As much as everybody loves saying they want to go to Florida, there's a lot of good things about New Jersey, which, are reasons to stay here. But we're going to get into the Southeast and maybe even some Western markets like Texas and Ohio.
So you love New Jersey and retail. I think you might be a weekly guest on this show. Right. This is going to be a repeating theme. Right. Thank you for bringing that up. Mm-hmm. Let's move on to your view of core versus value add. What do you see? Some of the benefits, some of the challenges, and really, how would you define both of those? Because there's a wide, I guess, impression gap on what core and value add really is.
Yeah, I mean, I think it's different for every investment group. For us, true core, we're not really buying. If it's single tenant land lease type stuff that's 20, 30 years leased, you're buying at very low single digit cap rates. That's not really for us, not at the moment. At some point in our investment profile, as we grow older and more mature, maybe we transition to true core assets. There's obviously some tax protection there that can be taken advantage of. So we focus on core plus as far as internal assets go and what we want to hold for ourselves. And that could be, for us, grocery anchored, inline service type retail, which we've done in Bergen County and been very successful with. Stuff that just will not drop below 95% occupancy no matter how hard we try to get our rents up. So for us, core plus is the grocery anchor type stuff that maybe has a 5 or 7 year kind of lease expiration coming up on the anchor and has all these inline services that just, people need. I feel like besides housing, grocery anchor retail is something that, every market needs, every community needs. So, but within that, there's also opportunity. There's different types of grocery anchors, and there's a difference between obviously a Piggly Wiggly and a Publix and, a local market versus a ShopRite. So there's different valuations there. And the value add is the kind of things where we are either coming in to fix something physically, financially, maybe contractually, or even related to the borrower and owner, which, is a market that is now kind of coming back around and reemerging. Deals that we used to chase vehemently and never give up on, but still couldn't come close to a number, are now coming back to the point where, either there's an email that says back on the market, which is just telling in and of itself, or brokers that we were trying to get in with in other markets are now chasing us. So it's kind of, the market is slowly turning, and that's kind of where we like to live when things get a little weird.
That means opportunity, right?
Correct.
Weird and dysfunction means opportunity if you can stomach it. So
Correct.
That's good. I'm glad you're in that space.
Mm-hmm.
Have you looked at anything, or would you consider anything non-grocery anchored? Because there are, I know this may be shocking, but there are other types of centers besides grocery anchored in retail. Not talked about as much,
right.
But would you consider something that wasn't grocery anchored? And if not, why?
No, we definitely do. We own some non-grocery anchored centers, which are literally just service type centers, and they're great. It's the shoe repair guy and the pizza guy and all the Chinese food, and those are all staples of non-grocery anchored retail, and we like that stuff, especially if it's in markets that we know. And there's some interesting deals out there right now that had grocery anchors in them and now don't. That are back in the market, and it's literally trying to figure out those puzzle pieces. What do you do with the big box now that it's empty, but yet right next door there's 30,000 feet of inline. So it's there's interesting times. It's interesting when you see like a ShopRite upgrade and move down the street. They leave behind a nice big box that maybe you don't have a user for right now, but those centers are back on the market, and they're maybe not distressed in traditional sense, but there's a value add / opportunistic component there. If you can figure it out and buy them relatively cheap, there's opportunity there.
So how far down the risk spectrum would you go, right? Are you looking at, like you just mentioned, maybe an anchor reposition, but the market is still very, very dense? Kind of what's the pivot point for you when it's just too much risk?
Right. I think in large part, the financing markets will tell us a little bit, because we are borrowers, so we just don't buy cash. So you end up revolving around that finance pivot point a little bit. But for good centers, we will even go down to ground up development. This one particular deal, I won't say which brokerage firm is shopping it, but they're out there. They're out there with a deal, and the opportunity may be to scrape that box. In New Jersey, at least, the opportunity has arisen through some affordable housing legislation, which has made towns focus on redevelopment, and opportunities have come up where they would not have come up 10 years ago, where you can now take a center and maybe do a mixed-use development and add a component of residential that makes a non-financeable project very financeable.
Would you attack something that required a variance or zoning change to add that residential component? That's a big if there.
Yeah, we are silly enough to try that every once in a while, yes.
Brave.
Yeah.
Brave enough, I think
Yes.
is the right word
Right.
there.
We've done it in the past and had sometimes have had success, and other times have had not great success, but at least what we try to do is value that real estate at its core. And if the variance doesn't go through, we're still making a decent investment, maybe not the grand slam that we had hoped, but the backup plan is still in place and we're doing okay. So we've done it before.
So have the home run strategy and then have a viable backup plan.
Exactly.
To be safe.
Yep.
Makes sense.
Yep.
Is there a tenant mix that you are especially bullish on right now that you think really just gives that fantastic vibrancy to a center? Or are there any concepts that you would love to have in your investments?
Yeah, I think it's a two-part answer, right? There's tenancies which typically have not been, in, at least from my experience, not been a heavy component of retail use, which in large part nowadays is healthcare. There's a healthcare component to a lot of retail centers.
Medtail.
Right.
It's everywhere.
It doesn't bring vibrancy. It may bring customer base because, the patients are waiting or somebody's going to grab a slice of pizza, but it's a component that can't be ignored, and I don't think is going away anytime soon.
You brought up something really interesting, though, the distinction that I just want to stop for 1 second. Vibrancy versus just traffic, right? Because those are two very different things, right?
Exactly.
The Medtail, you might have the numbers, you're going to have the cars, but you're not going to have that exciting destination retail feel.
Exactly.
So how do you balance the two, right? You don't want all medical,
right.
But they're good, solid tenants. So I think that's a good point.
I think there's some great projects out there in Jersey that have been a long time coming, and you finally, I think, again, just some of the affordable housing legislation has forced some of these redevelopments. But one of my favorites, which I wish was one of our projects, is the Hikimian project up in Montvale, the farm at DePiero's. It's just a great mix of multifamily housing, and it's retail, and you got a Wegmans, and you have now office even, which is so rare to see spec office go up. But it also attracted, one of the local hospitals to do a build-to-suit. So it's and that was a project born of necessity because Mercedes moved out, A&P left town, Sony left town, and it kind of left a big gap in the ratables. So I give that town and that developer a lot of credit for venturing out into the world of mixed use, because it really works. But as far as vibrancy goes, there's nothing like a good set of bars or restaurants, that have outdoor seating and just great architecture and that feeling. Down in Princeton, that's a great, kind of mixed use development as well, where you can go from one restaurant to the next and it's vibrant and you feel like you're alive. You can see people and that's
energy,
right? And that's the reason I like the Southeast markets as well, because that's all year round. Versus days, There's days like yesterday when it was 90-mile-an-hour winds in New Jersey.
It was sunny, though. That was nice rain. What about entertainment concepts? Some of those obviously are indoors. We've got our very talked about pickleball concepts. There's Topgolf and every iteration of that. How do you feel about entertainment? Would you want that in one of your centers, maybe even some of the smaller scale tenants, or do you think they're too high risk?
I think they're, for our profile, I think they're a little too high risk. And I think also a lot of those entertainment concepts, kind of flirt with the big box kind of category because you need a lot of space. Pickleball needs space, go-karting needs space, any
That's
of those.
really cool, though.
Yeah,
the
it's
electric indoor go-karts.
Yes, that's a lot of fun. So those are very big concepts that, at least for us, we're not power center people. We're probably not buying most big boxes because I don't necessarily believe in that business model anymore. There's a lot of reasons not to. I have 3 teenage daughters who, they never go to a big box center. They shop and return things via the internet, and they go to the mall on a special occasion. It's not like they go very often, like I did as a kid. Yeah,
right.
Or they go for the movie theaters. But that's one of the reasons the movie theater concept is great, and those entertainment concepts are great for certain spots. I don't think that's in our immediate target zone right now.
Okay.
Yep.
I can say that not everyone agrees with you on this. We have a lot of clients and guests who are very excited about entertainment because of the energy it brings to the center.
Right.
And maybe they're shopping and you go do, axe throwing with the family. I don't know, whatever the concept is, right? So I think that although there is turnover in the entertainment space, that it's still an important piece to a center. Maybe not the whole center, maybe not 50% of the GLA, but I think having some of those concepts mixed in actually can be a stable play.
On that level, I don't disagree at all. Like the Garden State Plaza expansion and how they're going to be building in different components of entertainment there. Those are great ads, I think, for the stuff that we're looking at, which is smaller box. It just doesn't, it doesn't
Square
fit.
footage-wise doesn't work. Yeah,
exactly.
Yeah, exactly. So let's move to mixed use a little bit. When you're kind of penciling out a new mixed use development, whether this is a scrape or it's clean ground up, or maybe it's a little bit of, mixture of what's there in a rebuild, are you forward thinking on the retail, or does the multifamily usually drive the mixed use, or is it even a healthcare component? Where do you start when you're making a mixed use development work?
I think it depends on the scale of the project. If we're doing 100 to 200 units at a clip and they're suburban based, the retail is usually the trailing component of that. We worked on some large scale redevelopment back when Harrison, New Jersey used to be brownfields and there wasn't even a stadium there. My partner Joe was involved, and he was kind of the first guy who came up with the concept of redeveloping the city of Harrison back at our days at a different company. And the idea there was to have a main street that had bars and pubs. And at that point, we brought the Metro Stars to the table, and they built now the Red Bull Stadium. And the idea was to have this main corridor of mixed use where the retail was just a big of a driver as the multifamily was. It was supposed to be like a vibrant downtown city.
Right.
And Harrison has done a great job. The administration there has been great as far as working with development companies and getting projects up and running. And you can see there's thousands of units there right now. The only lacking part is that kind of main street downtown vibrancy. It didn't take off.
Okay.
And I think that is just a balance of, all right, well, when does that big retail component come in if you don't have the residential base to support it?
Okay.
And I think the residential base got a little bit ahead of the retail, and there's still some land pieces there that are located, amazing locations right next to the pass stations that hopefully you see that component kind of come in now that the residential base is there. So it depends on the size. On that size, where it's a whole redevelopment area, the retail has to be a main component of that plan. Otherwise, you just end up with,
more housing.
More housing.
More apartments.
More
and nothing
apartments,
there.
and everybody going somewhere else to go to the grocery store or
Right.
going to the bar, or they don't come home and entertain themselves. They do something else. So
They go elsewhere.
Yeah.
Yeah.
Right.
What about densification of existing retail properties? Kind of the opposite of what we were just talking about, where you have a multifamily project planned and you're solving for the retail component. What if you had a great shopping area like Garden State Plaza in New Jersey, and now you're adding the other components? Maybe it's more retail to densify unused parking. Maybe it's apartments. Do you ever look at it the opposite way? Like, we love this retail. How do we make it mixed use?
Yeah, I think that's a natural progression. Just,
Okay.
when you see a great piece of retail and a great location, again, I think it's a relatively new concept to New Jersey to have these components really mixed together. And, whether the towns are forced into doing them or they're progressively thinking about them, things are changing. And those are the kind of projects you see that are developed from ground up in the Southeast. Those are already kind of built together with all those components coming in. And so it's interesting to see that happening here, in our home base.
Mature market.
Yeah, exactly.
That's maybe a little more challenging.
Yeah, exactly.
Speaking of markets, you've mentioned the Southeast a bunch. I'm sure you're long on Florida, like most people, but what other markets are you targeting and why?
As I mentioned, we're kind of entering a second generation of our company where we have 20 years under our belt. We feel like the market timing is good from not only an acquisitions perspective, but from a development perspective. We're growing our third-party management business to take advantage of some of the distressed assets and lenders who kind of need help, because we bring what I think is a truly entrepreneurial focus to every asset, which is we treat every asset as if we own it ourselves, whether we're a third party or a 5% partner or a 100% partner. And now the opportunities are starting to come back, and we are reaching out, obviously, into the Florida markets. We've been making friends there for the last year and a half. We haven't bought anything because we've just been waiting and getting to know everybody. The Carolinas we're looking at. Georgia is certainly a very vibrant market, certain parts of it. And I've got 2 kids in school in Florida, and I've got one who's probably going to end up in South Carolina. So,
good reasons,
reasons to visit as well. But, also there's certain markets of Texas that, I'm told we have to go look at. There's certain markets in Ohio that I'm told we have to go look at. I mean, we were both, in Salt Lake City recently, and you can see there's vibrancy there. Maybe there's markets to look at out there as well. So, the plan is to grow the portfolio, to do it smartly, slowly, and eventually have kind of the Eastern Seaboard at least connected at some point with assets.
And do you get excited about a market because of the population shift, because of the new projects you see there, and just the design of the cities? Like, what about a market do you say, wow, this is a really great place? Because I personally feel that there's opportunity in even the most tertiary of markets if you have the best position in that specific area, right? And I don't think everyone needs to focus on Austin and, Miami and so forth. So I look at opportunity a little bit differently, but what about those markets is most appealing to you?
Well, I guess a couple things. One is certainly population movement, right? And where people are headed. When I do an annual trip with my high school buddies to Fort Lauderdale, Miami area, and right before COVID, we would go to Miami. We'd go out for dinner on a Friday night, the Brick will have. And there'd be no lines for restaurants. It's a business district, so you wouldn't see that kind of push. But then you start, COVID happened and people started migrating, and you start to hear the numbers for just South Florida alone as a microcosm, and it was literally, I think, 200,000 to 300,000 people a year were migrating there. And we would, I think we skipped 1 year because of COVID. Yeah, it's a lot. And by the time we got back, I think it was 3 years later into Miami. Those Friday night bar scenes where you were online for 20 minutes.
Wow.
I'm standing next to O.J. Simpson, as he's trying to get into a place, and it's
strange.
And it's strange. It was a steak place with steak knives, so maybe a little nervous.
Sure, there's more of a story there, but okay, for another time.
Right,
okay.
But you could actually see the population growth, and Brickell Ave, which was a CBD business area, was now a vibrant, mixed use community where people wanted to go and hang out. If you didn't want to go to South Beach to hang out,
right?
So those kind of things are exciting. There's also, for people like us, there's an easier path to development. New Jersey, we've got 3 projects, that are literally, it used to be, 2 to 3 years in Jersey was a long time to get a development project, or a standard time. Now we're talking 4 to 5 to 6 years sometimes, and 2 of our projects are in that category. Yeah. So it cuts both ways, right? It's the barrier to entry in New Jersey is so high that if you have projects and you have the wherewithal to get through them, you're head and shoulders above the rest of the country, because nobody else can get in here, and that's why being a local real estate owner developer is, an important thing. So the barriers to entry in those other markets are a lot lower, but
competition.
But you can deliver to a market you can predict instead of 4 to 5 years away.
Right.
But there's some beautiful parts of this country that are on the water, or just the weather's nicer, and those things are exciting, and you can hear them in people's voices, and when they talk about retirement plans or their own business expansions, and so that's kind of what gets us excited.
I think you just like to travel to Florida, looking for a business excuse to do something.
That's part of it too, I guess.
All that makes sense. It really does. But I love that you pointed out that the barriers to entry kind of create intrinsic value in the Northeast when you can get a project done. Yeah. Timeline's very difficult. We've heard that over and over. I mean, you just look at the market disruption in the last 5 years. Can't even fathom, right?
We're working on an industrial project that we have now missed one complete cycle. We may be delivering into a new cycle,
right?
So it's very hard to predict, and we're very deeply vested in getting this thing done. And by the time we're finished, we'll be in probably market cycle 2.5, I guess. So
that's crazy.
Yeah.
Right?
Yep.
Yeah, you just got to remember everything's cyclical. So wherever you finish the project, it will go to the peak at some point.
Exactly.
So, but I'm sure that's a great project nonetheless.
Hopefully.
We've heard a lot of discussion about insurance premiums and increased costs. Obviously, some of the southern states with hurricanes, and out west with wildfires. So there are unique challenges from environmental perspectives that are affecting insurance premiums. Is that a consideration? Are you more concerned, even up here, about flood zones? how are you dealing with the insurance costs, and is that weighing into where you decide to invest or not invest?
Yeah, it's a real time problem, especially in the Southeast. Florida, and not that it. I think it's different per asset class because we've bid on a lot of multifamily projects, existing projects in the Southeast and in Florida, where we get a pro forma from an owner and he's showing $300, $400 a unit in insurance costs, and we'll go bid on that project with those numbers and get a cost from our own insurance providers that is $1,300-$1,400 a unit. So it's 4 to 5 times.
That's dramatic. Wow.
That's dramatic, and
Wow.
and that's literally as of 3 months ago we were having that experience. So from an acquisitions point of view and a seller's point of view, that $1,000 a unit difference in multifamily drops to the bottom line. So their NOI drops significantly when we look at it as far as trying to buy it, and therefore it only widens the bid-ask gap between seller and buyer. And our experience has been, nobody's willing to accept that at the moment.
Right.
So the sellers hold, and we don't buy, and we just don't come to the meeting of the minds. So I think in retail and in warehouse, arguably it's a little bit different depending on the submarket, because if you have a triple net lease,
it's a beautiful thing.
It's a beautiful
really
thing.
is.
But I'm also surprised that tenants haven't started to maybe catch that and pay attention to it and start to put restrictions on those types of expenses.
Such low vacancy that the tenants need the space, right?
Yep.
So it's definitely a landlord's market.
Yep.
And that's why. If it shifts, I think that's something we're going to see more of. But right now, it's great.
Yep.
Right. For you, for landlords.
Right.
Sorry to all the tenants listening. I know it's hard.
But it will be interesting to see what happens there, whether that gets regulated and smoothed out by legislation or just just capitalism kind of levels itself out. Another few competitors come into the markets and reset pricing. But
there's got to be a break point. I don't think it can continue at that level of increase. And especially if you're pricing a project out 3 years or 5 years, 6 years, how do you even factor in where costs like insurance will be in 5 years at this rate? That's really challenging.
I think there's probably somebody out there who's smart enough to figure out how to hedge insurance costs and can buy at current rates and then watch them come down and make some money. But that's not me. We're not.
I wonder if that's a thing.
Yeah, we're not hedging.
Interesting. Okay, next episode. So we're going to find out.
Right. I have to get an insurance expert in here.
Yeah, exactly. It should be a business if it's not.
Right.
Interesting. What other challenges, aside from cost inflation and approvals, what other challenges are you facing in your business today, and how are you overcoming them?
I think if you'd asked me that 6 months ago, it was the debt markets. Everything kind of froze, and even our relationship banks were giving us terms on deals that were so onerous that we're just like, well, this doesn't make sense. We were back to full, personal guarantees and stuff, which we haven't done in a very long time. So it was just, they froze the markets by being just, I don't want to say onerous, but just, their requirements were so high that it kind of just froze the market on all different levels, whether it's private lending or. So a lot of the guys that we know who are the bigger boys went to preferred equity and rescue capital type situations. Expensive. And everybody was in that market. So I don't think a lot of money got out the door.
Right.
So this year, it's still that debt market is coming back alive, and we've started to. I've attended some roundtables where the equity is coming back to the table. They're willing to start to do deals. So the challenge right now is the bid ask is still wide. I
live that every day. Trust me.
Exactly.
It's brutal.
Yeah.
Yeah.
And honestly, I think, cap rates where they are now, these could be the normal cap rates for a very long time. When I first came into the business, cap rates were high single digits and low double digits depending on the asset class. So, the day of the 3.75 cap for any deal, I think might be gone for a long time. So,
I think so too.
Yeah, there needs to be some normalization in the market, and that may come through just distress, refinance situations and the like.
Right. I want to go back to the debt market piece for just a second. So are you finding success with your relationship lenders, or are these new lenders you're going to? When you said things have eased, what does that look like? Is it just
It's more hearsay than anything because we don't have anything under contract. But I'm hearing
Sounds
that
really good. I'm really happy about it. Okay,
I'm
go on.
hearing that the markets are stabilizing.
Okay.
Interest rates obviously have stabilized a little bit. They're
Right.
not shooting up anymore.
Right. Thank God.
Which was what paralyzed everybody, just not knowing where that was going to go. But as far as new deals go, it's a little bit of hearsay on our part because everybody's saying they're going to lend money. So let us bring a few deals to the table, and then we'll see what happens.
Okay.
Yep.
Yeah. I mean, we're getting decent quotes on our stabilized product. It looks like lenders are anxious to get money out. It's just, again, the bid-ask spread and the negative leverage that is continuing to be challenging.
Yep.
So
Understand it. Yep.
Not sure when that breaks, but I agree with you.
Yep.
What are you most excited about for 2024? What are you most bullish about, or what are you hopeful about for the coming year?
Yeah, it's kind of a softball question for us because we're pitching this rebrand of the company and kind of the second generation. So everybody in the office is very excited about getting going and starting to roll out some of these new hiring announcements, and we're recruiting, and I will say on all levels, so from admin all the way up to some senior partners. I think also this lull in the market has also creates some opportunities for personnel and thinking about what they want to do, and maybe their comp packages were not what they thought a year ago because things are slow. So it's created not only real estate opportunities, but I think good people are reevaluating what they want to do. So we're excited about bringing some new people on. We're excited about getting into some new markets. We're excited about a lot of stuff. I think, as I said, we're growing a lot of the different divisions and just starting to pitch some new business, and everybody's just raring to go.
I love that you said that good people are reevaluating where they want to be. So that's a much more interesting statement than just saying the labor market is opening up, right? Because it's still very, very tight.
Yep.
But there's been enough time where people are starting to just reevaluate what the next step is. And I could see where that would be a very good time for you to pick up some interesting teammates. And
what's also interesting I found is, a couple of years ago, we couldn't hire a front desk person to save our lives. It was, scrounging through the classifieds.
Right.
This time around, we make the call. We got 3 interviews lined up. Not a single one of them has asked about work from home policies, so I find that pretty interesting.
Very interesting. Okay.
Yeah, because it's not a policy. We own office too, so we don't love the work from home thing at all.
We don't talk about it.
But it's interesting that nobody has asked about it because maybe there's a little bit of a shift there.
Or maybe it's assumed that they get some flexibility. I wonder.
Ooh,
kind of interesting.
They're not assumed with us.
You're listening and you're interviewing with Jason. Do not assume you have flexibility.
We're a real estate company. You got to be in your real estate.
No, I agree. We're in the office all the time. I think it's super important. Totally agree.
100%.
Anything else you'd like to share with our listeners? Or here's actually a better question. What would you like people to bring to you? Right? Is there a certain type of deal or a certain type of maybe employee, or when would you like someone to reach out to you?
Sure. I mean, I think it's multiple tiered, and I'll make it quick. I think from the perspective, we're trying to grow a third-party asset management and property management business.
Hold on. We didn't even talk about that. You just kind of went through. We do this whole other thing, right? So, okay, we got to freeze for just a minute.
Yep.
What kind of assets do you manage? How big of a part of the business is this? Just let's dive into this for a second.
It's a growing part. So right now, I think we probably have half a dozen assignments for asset and property management. It's something we're growing through our medical offices, through our regular office buildings. Part of the dirty secret is there's no money to buy office, so we have a hard time investing in it, even if we love it. We don't always love it.
I don't think that's a secret, actually.
Right. Right. But the other side of it is that these assets are having troubles, obviously. So when they come back around, that's where we want to be, is to take that kind of ownership point of view, but maybe help some non-traditional real estate owners with their situation, help some lenders, some local banks. We've already, been talking through a couple of assignments like that. That really where we can come in, apply our asset management skills, our construction management, and help reposition things and stabilize them. And that's, we've spent a lot of time focusing on that.
Interesting. It's like a partnership model.
Yeah. I mean,
I was thinking property management, which is very different when you first said it, but this is
and it's
completely different.
Right. It's property management. We kind of look at it hand in hand, property management and asset management. You hire us for a property management contract, and you're getting asset management that comes along with it, because we can't help ourselves. Right. We have to try to fix things. We want to make it better.
So it's not just parking lot sweeping.
Right, exactly. No,
Repositioning.
it's repositioning, yes.
Basically, people don't know what they're getting into.
Right.
Hire your company, and they're like, hold on.
Exactly.
This is mixed use.
Or,
What just happened?
Exactly. Or lenders who just, they don't have the staff or wherewithal want to handle running a property. So that's kind of where we think we fit in well.
Okay, so I took you off track there for just a second, but you're growing that part of the business. You're hiring new people. You're looking in new markets. Is there a certain type of deal that you would be very excited about if someone brought you?
Right. So bring us, like for example, a Publix anchored center that has 3.5 years left on the lease, but also has another 50,000 feet of inline, service type retail next to it.
Okay.
Bring us, something like that has an out parcel that hasn't been, built upon or expanded or anything like that. So as far as retail goes, anything in Bergen County that's in line, we love. Obviously there's great demographics in Bergen and Morris County too. And then mixed use stuff as well. If there's entitled property out there, especially in the Northeast, that maybe you can't build or you don't have the bankroll to get going, that's where we can come in and we're very entrepreneurial. We don't have you're looking at the decision maker, so it's like we can decide we can decide what we want to do when we want to do it.
Yeah.
We typically don't have an ego when it comes to real estate. If it makes money, we're probably going to take a hard look at it. So
best kind of clients.
Yep.
And then last question, do you partner when you're in new markets, or do you go explore them with your core team and do everything in-house? What's your structure there?
So the idea is to go explore markets, find deals that we like, and if that's a new market for us, we're probably hiring third parties at first, because we don't want to jump in and pretend like we know everything. It's certainly why we're not diving into just straight up development deals right away. So we want to find some existing assets to get going, build a little portfolio, a foothold, and then we can implement our own team and get going there. But the goal is eventually to grow our offices and add a few up and down the
state.
Yep,
right.
Exactly.
Nice.
Yep.
Last question, a bit of a curveball. You've been in the industry for several cycles now, I'm guessing. What advice would you have for someone new coming into the business, or someone who maybe this is their first downturn? How are you looking at this cycle, and what advice would you give to newer people in the industry?
Yeah, I think it's a natural part of the business, right? It's just the cycles come and go. As my partner used to say, it's going to be different, but it's going to be the same. And it depends on which asset class you're in. But, whether the cycle, there's opportunity on both sides of that bell curve. When the market's down, there's going to be some down and dirty stuff. When the market's up, there's always a chance to buy and sell. So it's just part of the business. And hang in there, because it will get better. It doesn't take that long.
Good.
Yep.
Like the positivity. This has been great. Thank you so much for coming on the show and sharing all of your insights. We're very excited about your new retail initiatives and wish you all the best of luck in these new projects. Can't wait to hear more as things develop.
Much appreciated. It's a great forum. So thank you very much for the invitation.
My pleasure. To everyone listening, that was CRE Fast 5 Secret Sauce. We're so happy you could join us, and we look forward to seeing you again very soon. Have a great day, everyone. Thanks again, Jason.
Perfect. Thanks, Karly.